Hi everyone. Let us continue discussing the capital budgeting methods, and we have discussed few methods that includes payback, discounted payback, net present value and internal rate of return in the earlier sessions. This particular session we will be talking about the rest of the two methods of capital budgeting, which is average rate of return or average accounting return, or the other one is profitability index or benefit cost ratio method. The average accounting return, which is AAR, or also called average rate of return and accounting rate of return that way, but average accounting return, which is the one of the common terminologies used, AAR, is actually return on the equity of the project. So, it is the ratio of net income averaged over the project span and the average book value of assets in the project. The average book value will depend on to the how assets are depreciating. Okay. So, what is the average value of assets and what is the average net income of the project in its lifespan is taken, and their ratio is basically estimated as average accounting return. It estimates all the net income and average net income, that is the typically first step for the computation of AAR, and then estimate the book values and average book value and calculate the AAR by taking their simple ratio. So, the formula is simple. We take the average net income, divide it with the average book value. The book value, particularly the average book value, is based on the depreciation primarily. So, the depreciation should be taken into the account, and generally the straight line depreciation is taken. So, if we take the straight line depreciation, our average investment becomes the historic investment, historic value or initial value minus salvage value by 2. So, what is the salvage value, what is the final value after the end of life of the project? That is to be subtracted from the invested value or initial value, and is because we are taking average, so we can divide it by 2 in order to get the average book value that way. So, if the accounting return or average accounting return is greater than a preset value, we can accept the proposal, or otherwise we can actually discard the proposal. So, let us take an example, okay, how these are calculated. So, assume an organization is investing 1 crore in a project for developing a mineral water bottling plant, likely to be depreciated using a straight line method over 5 years with 40% salvage value. So, the project timeline is 5 years and salvage value is 40%. So, that means the 60% of it, or equal to around 60 lakhs, will be depreciated in 5 years. The table is showing the revenues and operating expenses, and we need to calculate the average accounting rate using 30% tax rates if taxes are applicable on net cash flow and net cash flow after discounting for depreciation. So, there are two tax regimes, two tax model, and we will see how it makes difference when we go for calculation of average accounting returns. The information that is available to us is that the total investment, the salvage value after 5 years is 40 lakhs. So, our average annual depreciation, because 60 lakhs has depreciated in 5 years, so average annual depreciation is becoming 12 lakhs. Okay. Now, if we consider the data given to us in form of the revenue and operating expenses were given to us, okay. So, we can get the net cash flow by subtracting revenue minus operating expenses. Okay. So, if we subtract revenue generated minus operating expenses, we get the net cash flow, and we have the depreciation value as 12 lakhs per year based on the remaining salvage value of the asset. So, this information is available to us, we know what is our net cash flow and what is the depreciation. Okay. Now, as discussed as basically given that there are two different tax regimes. So, let us consider first the tax model A. Okay. So, the tax model A suggests that there is going to be 30% tax onto the net cash flow. So, we have revenue, we have the revenues known to us, operating expenses known to us, then net cash flow known to us, depreciation is also estimated. So, the taxes are going to be 30% onto the net cash flow. So, what is cash generated? 30% onto that. So, we multiply with 0.3 to these numbers and we get the taxes, and then we can get the net income by subtracting taxes from the net cash flow and depreciation as well. So, our net income becomes the net cash flow minus depreciation minus taxes, and that is how we get these different net incomes. So, our average net income if we see, so the 5 year is the project duration. So, we get annual net income from these 5 years. So, we will take the average of these values and that is coming out to be 4,10,000 rupees as our average net income. Okay. Now, consider the average book value. So, it is a straight line depreciation as was assumed initially. So, the average book value for a straight line depreciation will be initial outlay minus salvage value divided by 2. So, initial outlay was 1 crore, salvage value 40 lakhs divided by 2. So, basically 60 lakhs divided by 2 will be equal to 30 lakhs. So, our average accounting return or AAR becomes average net income by average book value. So, that is 4,10,000 divided by 30 lakhs, which is coming out to be 0.1367 or 13.67% is the average accounting return. So, that is how the average accounting return is estimated, and if let us say we have a cutoff value of say 15 as an average accounting return, then we should not accept this proposal. If we have a cutoff value of 10 or 12 for average accounting return, we can accept this proposal. So, that is how the decision is making. Now, this was the tax model A. Okay. We have another tax model where the taxes are applicable onto the depreciation, the value after depreciation. Okay. So, for this case these 4 estimates are we have already done that. Now, the taxes in earlier case it was applicable on net cash flow. So, the net cash flow was revenue minus operating expenses and we apply 30% taxes onto those, but this tax model says that okay, you can actually subtract depreciation also, because there is a loss in the value. So, you can subtract depreciation and then apply taxes onto the leftover value after depreciation. So, 13 lakhs for example is the net cash flow and 12 lakhs is the depreciation. So, net income for the taxes becomes 1 lakh in first year, and 30% of 1 lakh means net cash flow minus depreciation becomes 30,000. Similarly, here 21 lakhs was the net cash flow and 12 lakhs depreciation, making it 9 lakhs, and 30% of 9 lakhs is 3 lakhs. So, that way the taxes can be estimated, and then net income again becomes the net cash flow minus depreciation minus taxes. So, this will become our net cash flow or net income. So, average net income will be again taking the 5 years income independently and taking average of that. Now, this is coming 7,17,000. So, earlier it was 4 lakh something and now it is 7,17,000. Why? Because the taxes were paid onto the net cash only, and in this model the taxes on depreciation were waived off. So, there was when we discount for depreciation, the net incomes become very less, and that is why the taxes become very less. So, all the saving that is seen is actually in the form of taxes, okay, because net cash flow is still remain the same, depreciation remains the same, only thing is that taxes has reduced, because earlier taxes was applied onto the net cash flow and now it is applied onto the depreciation. So, the government could have a different taxation model. So, if they are allowing depreciation to be discounted from net cash flow for estimation of taxes, so that that way the average net income becomes more because taxes will be less. But if they are considering that no, that depreciation is the organizations or firm's own problem and we are not interested in accounting for depreciation, will impart tax on your net cash flow, then taxes are going to be higher and average net income will be lesser. So, earlier it was 410, now it has actually increased to 770 that way. The average book value remains the same, 1 crore minus 40 lakhs, so 60 by 2 is equal to 30 lakhs, and then if we compute the average accounting return again by the average net income by average book value. So, 770 divided by 30 lakhs is becoming now 25.67, and then the average accounting return is of the order of 25.67% now for this. So, earlier it was some 13.6 or that kind of number was there, now it has exceeded to 25. So, if because of the tax relaxations. So, that way the average accounting return can be estimated. Now, if our earlier criteria was 15 for this to be accepted, so this tax model or this scenario can be accepted while earlier cannot be. Okay. So, that is how the average accounting return is estimated and helps in the decision making towards capital budgeting. Okay. The advantages and basically includes that it is easy to calculate and need information will be usually available, whatever information needed. Okay. And if the internal rate of return is high enough, again we may not need to estimate these numbers. The disadvantages on the other hand, that it is not true rate of return, it is based on the average value that way, and one of the major problem is like the simple payback period method, the time value of money is ignored in this one also, because we are taking average. So, the time value of money has not been taken into the account even in this approach, and that is one of the major drawbacks. Further, it uses a arbitrary cutoff point that okay, if it is exceeding this I can accept, if otherwise I cannot. So, all these issues are there, and it is the based on accounting net income and book values and not the cash flow and market values. So, these are some of the disadvantages of the approach. And then there is another method for capital budgeting, which is benefit cost ratio, or also known as profitability index. Okay. So, what benefit cost ratio is, we have already discussed earlier that it is a ratio of the benefits to the cost, but in terms of capital budgeting or profitability index, what we determine is the ratio of present value of the future cash inflows to the present value of the cash outlays. So, the present values of the cash flow is divided by the initial investment in order to get the profitability index. Okay. The computation method is again simple. We need to estimate the expected future cash flow, estimate the required return for the project, and find the present value of the cash flow and divide it by the initial investment in order to get the PI. The basic formula is actually, as if you see the discounted cash flow or the net cash flow with the time value of money is actually this number, as we have seen earlier also in case of NPV and this thing. So, that becomes our net income, and C0 is the capital investment, net income in terms of present. Okay. So, this becomes the net income discounted to present, which is discounted, and if we divide it by the C0, what we get is the our profitability index or benefit cost ratio. Okay. So, this can be solved, it will eventually come as 1 plus NPV by C0. So, if we are able to get the net present value, so then because the net present value, if you see, NPV is this discounted rate minus C0. Okay. So, let us call this as a net income NI. So, this is NI minus C0 is NPV. Okay. Now, NI from this equation can be written as NPV plus C0, because C0 can be taken here. So, we can replace NI as NPV plus C0 divided by C0. So, it will eventually become NPV by C0 plus 1 or 1 plus NPV by C0. So, we actually get this number. The decision rules are simple, except if benefit cost ratio is greater than 1. The higher the benefit cost ratio or profitability index, the better the scenario, the better the project is. Let us take an example, okay, how this is used for capital budgeting. So, the investment for a water park was estimated as 2.2 crores. The expected operation and maintenance expenses and revenues generated are given in the table. Okay. The tax rate on net cash flow excluding externalities are 30% up to 20 lakh income, 40% for additional income between 20 to 50 lakhs, and 50% on any higher income. Further, the EIA of the project has valued all positive externalities as 1.6 crore, while negative social and environmental impacts are valued at 2.1 crore. So, externalities, in terms of externalities, if you see here, so this is 1.6 crore and 2.1 crore. So, there is a net loss, because 2.1 is negative and 1.6 is positive. So, there is a net loss of 0.5 crores. Okay, for the project duration of 10 years. So, these externalities are wholesome for a project duration of 10 years. See, assess if project is economically feasible by estimating the profitability index at 10% discount rate. So, that is the problem. We have been given the operation and maintenance expenses here. So, what we will do for such problems, that operation and maintenance is given to us and revenues is given to us. So, we can get the cash flow by subtracting operation and O&M expenses from the revenues. So, that way we will get actually this cash flow. Okay. So, those numbers were in lakhs. So, this is going to be in the lakhs. Now, there is going to be the tax onto the cash flow. Okay. Now, the tax onto the cash flow will actually is divided into 3 slabs. The tax rates have been given. So, the tax rates are 30% up to 20 lakhs, then 40% up to basically greater than 20 and 50 lakhs, and 50% for any higher income. So, now if you see the net cash flows, this becomes very important row over here, because that will give us an idea how much tax is being imparted. So, this is net income is 25. So, first 20 will be charged at a 30%, while the other 5 will be charged at a 40%. This is how typically government tax slabs are. In the second year, net income is 50. So, 20 is going to be charged at 30% and 30 is going to be charged at 40%. There is no income to be charged at 50% in the first 2 years, but since third year onwards, when it is becoming 54, so 20 will be charged at this, 30 will be charged at this, and 4 will be charged at the uppermost slab. So, that way for all future years, because the net income is higher than 50, so 20 is going to be charged at 30%, next 30 is going to be charged at 40%, while the anything that is higher than 50 is going to be charged at a 50%. So, the net calculation of taxes, for example, let's take an example of year 4. So, net calculation of taxes will be 20 into 30%, so 0.3 plus 30 into 0.4, 40%, and in year 4 we have 25 in the upper slab, so plus 25 into 0.5. So, if you sum this up, it is actually becoming 30.5. So, that way the charges will be calculated for the total tax, and then we can estimate what is the net tax onto this income. So, net cash flow after tax will be, we know what is the cash flow and what is the taxes. So, we can subtract taxes from the cash flow and we can get net cash flow after the taxes. So, this is this column will give us the net benefits after taxes, and we will have to apply the discounted cash flow as we have been doing earlier for other methods as well. So, we will apply the 10% discount rate onto the cash flow in order to get the discounted cash flow. Okay. The discount rate is 10%. So, for example, the net cash flow, if let us say 60 here, so it is going to be 60 divided by this 7th year, so 1.1 to the power 7, that will be 30.79. So, that way we can estimate the discounted cash flow. Okay. Now, once we know the discounted cash flow, this is going to be our net income from the project. Okay. As we have been estimating for NPV also. So, this is a similar exercise that way. Now, the discounted cash flow or the net cash flow is the sum of this is actually 252.89 lakhs, sorry 252.53, it should be 53. So, that would be, and it eventually is coming 2.53 crore rupees. So, when it is 2.53 crore rupees, the initial outlay expenditure is 2.2 crore, okay. And if we want to estimate the benefit cost ratio straight away excluding externalities, let us say we are not considering externalities yet. So, it is simple that the sum of the discounted cash flow or net income divided by initial outlay. So, our BCR becomes 2.53 divided by 2.2 equal to 1.15, and project can be accepted. However, if we include externalities, so there are overall positive externalities of 1.6 crore, overall negative externalities of 2.1 crore. So, the net benefit becomes 2.53 minus 2.1 negative externalities and plus 1.6 positive externalities. So, this becomes 2.03 crore. So, this becomes 2.03 crore, and then we can take the benefit cost ratio, because now our benefits is 2.03 crore and cost is 2.2 crore. So, ratio becomes 0.92, and this project probably will not be accepted. So, this way it is actually one can actually see that the benefit cost ratio method can be used or can be adopted for the estimation of benefit to cost ratio, so that one can actually get an idea of whether this project is going to be beneficial or not. And we can account for externalities also, in not only in this but in all other methods. So, like even if we want to calculate NPV for this project including externalities, so the NPV for this project will actually be in that case 2.03, which is my net income, minus 2.2. So, that way minus 0.17 crore is going to be my NPV, and it is negative. So, actually will be rejected. Okay. So, that kind of estimation can be helpful in order to see, or in order to make a decision whether a certain project should be accepted or not. The method also has certain advantages and disadvantages. So, the advantages is that this indicates the maximization of the firm's value and is useful in case of capital rationing when we are taking the ratios. However, on the other hand, it can't give accurate decision if the amount of investment of mutually exclusive projects is not same. Okay. And it may not be easy to understand for many people that how the concepts, how the profitability or how the ratio values less than 1 or greater than 1 can be utilized for making certain decisions. Nevertheless, these were the basic capital budgeting methods which are typically used for the helping in decision making towards the accepting a project or not, and we have discussed these with examples. So, I hope that you will be clear in how to apply these methods. There are some specific special cases like when you are comparing mutually exclusive projects of different time frame or of different initial outlay. So, how we can assess those. So, we will discuss that as well in further sessions, but for today we will close the session here, and subsequent discussions will be made in the next session. Thank you.